Mortgage rates continue to climb, putting further pressure on home buyers. Their salvation is always to be able to rent. However, today in most major U.S. cities, rent prices have skyrocketed over the years, making it completely unaffordable to the majority. This only gets worse as other costs increase, such as food and electricity. Eventually, this has to come to a full stop when the debt buries the borrower and bankruptcies increase. You came here for the truth, so let me unveil that for you. Now, today we're going to look at real estate. We're going to look at rent. We're going to look at home prices. I want to note where people are moving in and out of. I have a lot to cover, so let's begin by taking a look at this. It's an article out of Market Watch, and it's talking about real estate prices and so much more. Housing market headwinds are keeping American homeowners in their properties for the longest stretches on record. So that right there shows us that something is going on. Whenever we see record highs or record lows, we need to start paying attention because it's not so one-sided. We need to understand all of the details. Across the country, homes that sold in the third quarter of this year had been owned an average of 8.23 years. That's almost double the length of time a home sold in 2000 had been owned. So clearly we have an issue. Now, what's different in between the year 2000 and the year 2018? Well, we've got a few things. Since 1980, we've seen that interest rates have been, on average, decreasing. Today, however, it is widely expected that interest rates will increase. If they're going to increase, it means that payments are going to be higher. It means that housing prices may be subdued. It also means that we're not going to have the easy money that we once did. If people are going to refinance their properties, it's going to become more expensive to do so. That means the payments are going to be higher. So some people can't afford that, so they have to stay put. And what we can see right now statistically, whether it's in the US or Canada or other places, is that with these increased costs, a lot of people have decided to stay where they are. Inventories have built up and the sales have declined double digits in many areas, like, for example, Toronto, Vancouver. I know for a fact they have decreased double digits in many cases. We're looking at up to 45%, I think was the maximum I saw year over year, and depending on which sector we're looking at and so on. But anyway, those are the reasons why this is occurring. And very important to understand that we have interest rates increasing at this time versus decreasing. Okay, so those are a few issues. Let's look at this here. As of the second quarter, 2.2 million homeowners were still underwater on their mortgages. But I thought everything was just fine today. I thought the GDP continued to increase. I thought unemployment rates were under 4%. What's going on? I must have been looking at some false information? Wait a second. Could it be that everything isn't so fine after all? Well, take a look at this. Homeowners are staying put longer. You could see what has occurred since the beginning of the year 2000, let's say, up until the financial crisis. This had been a time in which people stayed in their homes about 4 years, according to this chart. All right. But today, that has changed, and it seems to continue to increase, looking at over 8 years. Since the financial crisis. Kind of strange the way this has been. A decade of persistent steadiness around that 4-year mark, and then all of a sudden, it goes up to 8 years. Interesting. The prices had come down during this time frame. Interest rates were quite low, and yet people were staying put for longer. Something to take note of. Median asking rent for vacant for rent units from 95 to 2018, and clearly the trend is present. And that has been increasing practically year over year over year. We can see that the prices have come up just since the financial crisis. Looking at, it's hard to tell from here, but maybe about 25% or so. 25% since the financial crisis. If there's anybody that has seen their salary from their 9-to-5 job increase at a rate of 25%, that is probably part of a minority of individuals. There's no way that large groups of people have seen a 25% increase throughout this period of time. If you're lucky, 10%, 12%. Well, that brings me to my next point. The average millennial earns just over $684 a week, or $2,700 a month. And this information comes from the BLS. But in some of the more popular states, that income won't get you very far in terms of renting a place to live. So this is the issue I wanted to talk about here, where we're going to look into how expensive places are, but that's not a generalization. You need to look at it closer. This gets into a website, howmuch.net. I've shown you this website many times before, and actually I got emailed from How Much, and they said anytime that I wanted, they would produce a custom report with any data I wanted, looking any way I wanted, as long as I, of course, credit them, and they would do so. I haven't done that today, but I will definitely do so in the future. Fantastic resource that I believe everybody should check out on a regular basis. Just see what they've got to offer. Lots of free info for you to check out. Okay? And I always bring you the charts from there because they tell a whole story. And of course, that's what I like to do here on this channel. Now, what they suggested is that they're looking at the average price of rental properties in every state. They determine how much money a household would need to make in order to afford that rental price. And they base this on essentially the cost of your housing should make up no more than 30% of your income. All right, 30% of your income. And I find this interesting because I did a video, it must have been a few weeks ago, looking at this number compared to what we see in places like Vancouver and Toronto. And in Toronto, this number is something along the lines of 76 or 77%. And in Vancouver, it was something like 88 or 89%. It's impossible to afford this. This is completely and entirely unsustainable. And yet, who knows? It could only get worse. This is how crazy people are. In contrast, in several states in America's heartland and in the South, a person could make less than $3,500 a month and be able to make rent. So they're basically showing in here, and I'll give you the map in just a second, where certain places are so entirely unaffordable to the average person. But there's other places in the United States where definitely homes are very reasonably priced. Based on the rule of applying no more than 1/3 of income to housing, people living in the Northeast must earn at least twice as much as those living in the South just to afford rent for what each market considers an average home. That to me is crazy. That's crazy. But it's a problem that is truly apparent in California. The state's median household income is roughly $67,000 a year, comparatively higher than most other areas, but there is still a huge gap between its median income and the $99,000, essentially $100,000 a year needed to pay rent. You need to make $100,000 a year to pay your rent, or else you're going to go above that 30% mark. Now, the 30% mark, maybe it's just an arbitrary number, but of course, that has a lot of validity. Because if you're paying too much for your rent, what happens to your food prices, to your energy prices, to everything else? It's increasing every day. Even in a comparatively well-off state, over half of the population is considered unable to adequately afford an average rental. Think about that. Look at the map. We can see here how much monthly income is needed to rent a house in every state. California, my goodness, $8,300. DC, about $8,500. New York, $72. And just look around. even in some other areas like Florida, it's still very high. Still very high. But it's much more reasonable than New York or California. But you have to figure what we're talking about. There's two factors: how much a place costs, as well as how much you're going to make. So if you're going to make twice as much by moving to another area, well, maybe it'll end up being the same affordability. So these are factors that you need to look at, all right? And of course, looking at the state as a whole, that's not fair either, because you need to break it down even further. I would like to see cities, this broken down into cities, and we've seen some information like this before I've shown you. But this is a good generalization just to have an idea of where we're at, all right? So take a look at that if you're interested. This is a list view showing you all of the states that are just unbelievable when I look at it and try to think to myself, who in their right mind is able to buy into these things with the average salary? Goldman Sachs rental affordability measure: buying is looking increasingly less affordable versus renting, with home prices growing faster than rents. Can you believe it? Now, no matter how much rents are increasing, prices have increased even more. It's crazy. The two lines on here basically just showing you, the darker line is rent to income ratio and the lighter one is mortgage payment to income ratio. And that has truly increased right now. We're seeing that going to levels that we saw during the housing crisis. So we'll pay attention to that for sure. But essentially what I can tell is that things are just becoming too expensive. If it's not homes to buy, it's homes to rent, it's food, it's everything. Everything is too expensive. And what are they doing about it? Absolutely nothing. This right here is the mortgage rate, 30-year fixed. And the information is coming from the St. Louis Fed. I always like to show you the most legitimate sources possible. This gives us an idea of where interest rates are going, to look at this increase over the years and where it's most likely headed. You could see since the financial crisis, on average, it was trending downward. And that made it more affordable. Prices got boosted up as a result. People started refinancing. People started using their homes as ATMs. Now we got a big problem because the interest rates are increasing. People are staying put, as I discussed in the beginning, and inventories are building up in many areas. Does this mean that real estate is crashing today? No. There are some places that's not doing well, that's for sure. But we're at that point. It's kind of like a plateau where the prices are rising, euphoria's there, everything is just fine and wonderful. But now it's kind of leading to this point of what's happening here? And then suddenly it will have to decline. If mortgage rates are increasing, houses have to decline in price. If mortgage rates stay steady, housing prices may stay steady as well. And last but not least, if you want the financial education you were not taught in school, then these two books have it all. I'll tell you right now, if you want to read some fluff, if you want to read some information that's going to make you fall asleep, then these two books don't have that. What I do is I get into the absolute underlying facts, everything all the way from the foundation, all the way to the asset classes, how to make money, how to profit, and so on. You get everything without any garbage, without any jargon. Check the books out. Link is in the description of the video. If you're more interested in the audiobook version, you can get that at themoneygps.com.